Hello everybody, welcome to Talk About House. I'm Todd.
I'm Oana.
Okay, so today's video is about why people aren't selling. This is from a Fortune article that came out the other day. Here's the headline of the article. It's very descriptive. I can't afford to sell because I don't want to lose that rate. 3% mortgage rates will loom large over the U.S. housing market for years to come. Okay, first of all, we're going to talk about how the low interest rates of the last decade are affecting us now, and maybe what we have to look forward to in the next few years. So, as many of you realize, the federal funds rate has basically been held close to zero. It's effectively been anywhere from 0.12% to 0.25% for most of the last 8 years, except for a brief period in 2019 where the Fed raised rates and then dropped again, basically when COVID hit, right? That's when people were saying the housing market, the most recent time the housing market's going to crash, okay? So Oana, what are the two largest industries that are affected by rapid change in interest rates?
Banking and real estate.
Okay, let's talk about banking for a second, okay? How is a bank affected by a big change in real estate? Give an example, because we just had two banks go away.
Right, so that's a prime example of that. So banks have to take your money, right, when you deposit the money, and they have to put it to work.
Okay.
And they put it to work by investing it, and they'll invest it for the most part in very safe things like treasury bills and mortgages and things like that.
Okay.
And the issue with that is that the banks did invest the money in these safe things, and these safe things were paying 2%, 3%, something like that. But now interest rates are much higher. So those assets are actually worth less, because when they go to sell those assets, now they have to discount them very heavily in order for the purchaser to earn the going rate, which is more like 6 or 7%.
Okay, so you deposit money in a bank. Money's very cheap. They say, okay, we'll pay you 0.1% interest. We're gonna put it in an investment that gives us 2%. Okay, they put it in a 2% investment. It's 10, 20, 30 years, they get 2% on the money, which is really safe. Let's call it 100%. They're going to get it for sure, right? The problem is interest rates go up, and now money's 4, 5, 6%. So if you need cash and you want to sell your bond or mortgage-backed security, they're not going to give you what you paid for it, right? Because it's costing them extra money. So you have to discount the value of it to get to sell it,
right?
25% or whatever, right? So if you need liquidity, you're selling an asset for a loss. Correct. You're realizing a loss.
Yes.
Okay. Now let's talk about real estate, because it seems that maybe doesn't work the same way in real estate.
No.
Okay, so let's talk about real estate. For years, rates were locked in at 3%. Some people got 2, some people got 3, 4. How does that affect long-term home buying?
So the people who have these phenomenal interest rates are in a position where they simply are not going to part with these wonderful interest rates. They understand that these interest rates may not come around again for a long time, if ever in their lifetimes, so they don't want to part with them. That means that move-up buyer is not going to sell the house to purchase something else. Whether he's going to buy something else at all is another matter, but the house that he has this interest rate on, whether it's 2 or 3%, he's not going to be parting with that.
Okay, so imagine this. Remember the example we just gave with the banks, where if you sell your 2% thing that you bought, you have to sell it at a discount. Well, imagine this. You own a house, and you want to sell that house because you want to move the equity and go some other place and buy a different house. You're now trading your 2% money, and you're giving it back to the bank. Here's the 2% money I borrowed. And you're going to another bank going, I'm going to borrow money at 6%. It makes no sense to do that. So the rapid rise in interest rates has basically locked people in place. I'm going to give a good example here. I'm going to read a quote from the article. Although rates are down from the 7.37% peak, the 30-year mortgage rate came in at 6.5% on Monday. According to Goldman Sachs, 99% of borrowers have a mortgage rate lower than 6%, or the current market rate. Okay, of those, 28% are locked in below 3%, and 72% below 4%. Oana, 15 years ago, during the great financial crisis, when all these people had loans on houses, what percentage of home loans were below 6%?
Almost none. I mean, there were very few, and those were probably 15-year mortgages with stellar credit and very favorable loan-to-value ratios.
Yeah, loan interest rates didn't really start to go below 6 until about 2009 and 10. And then they went down. They kept going down. They sort of crept down throughout the decade. But the problem is a lot of people refied. Even the people that bought houses when the rates were higher, everybody refied. And they all borrowed, they gave back to the banks this high dollar money. And they've locked in this really low money. And no one wants to give it up.
Correct.
Right? Okay, so let's go through a couple quotes in the article. We're going to read the two quotes that people gave. Okay, one was retail district manager Corey Kinman. Refied his home in Riverside in August 2021 with a rate around 2.42%. Okay, after purchasing in 2016 at 3.68. So he bought it at 3.68. He refied it at 2.42. Save $500 a month, right? But the problem is he's splitting his time between California and Portland after getting a new job. Instead of losing the low rate he's locked in and selling his home, he's renting an apartment in Portland because he can't afford to buy there. He could probably sell his house in California, go buy, but now he's going to borrow at a higher rate. Okay, he's traveling between the two states for work, which is cheaper because of how reasonable his mortgage payment is. It's cheaper to commute back and forth and get rid of the house. I can't afford to sell because I don't want to lose that rate, Kinman told Fortune. If I ever want to move back to California, it's going to be impossible because I'll never get a rate lower than that. So I'm scared as hell to let go of the house at that rate. And I also can't afford to buy in Portland because the pricing and the rates are too high. Plus, Portland has the same problem. People aren't selling there too either, right? Okay.
So limited inventory, limited selection in Portland, high interest rates, and he has a house he likes in California, and it's got a great interest rate. He's got payments that he can afford, and he can afford them to the extent that he can afford another place in Portland plus transportation to and from. So that really gives you an idea the magnitude of the issue as far as people really not wanting to sell.
Okay, here's the next quote. Finance and economics professor at University of South Alabama, Bob Wood, told Fortune that he locked in a fixed 15-year mortgage rate around 3% when he purchased his home in Mobile, Alabama in 2014. Now, it was that low in 2014 because it was a 15-year mortgage. So the going rate about then was about 4. He got a better deal. The way that rates are going up so much right now, it just doesn't make sense to sell. Wood and his wife were looking to downsize, and after pricing it out a few times, they were happy with the numbers they were seeing. But now that rates have gone up, if they sell, they have to pay almost double for a smaller home. And that's the whole point of downsizing is you have a lower payment, right? Wood said they're just not willing to do that. They're planning on holding off and waiting for rates to moderate. We've got time to do this. It's not critical, Wood told Fortune, so we just think we'll ride it out. And hopefully in the next 12 to 18 months, the market will move. As Goldman writes, they're far from alone. Okay, there have been people who come in the comments and have said, oh, but Todd, when interest rates go up even higher, this will cause a massive amount of listings to hit the market and foreclosures and home prices will tank. But it's actually the opposite because interest rates have gone up, but inventory is going down.
Right. The higher the interest rates go, the lower the inventory goes because people simply do not want to pay that much interest when they're accustomed to paying, 3% give or take.
Okay, but if you have a 3% loan, like 72% of people have under 4%, and interest rates go to 7.5%, doesn't that mean you're being foreclosed?
Nope.
Because there's a lot of people out there that think if interest rates go up, foreclosures all of a sudden happen.
So most of the loans out there are fixed rate loans, which means that their interest doesn't change. So because their interest rate doesn't change, then their payments don't change. The only people whose interest rates would change, so whose payments would also change, would be people with variable rate mortgages. And because interest rates were so low, it didn't make sense for most people to have a variable rate mortgage. And even so, variable rate mortgages don't don't go to market value overnight. That they creep up periodically. So even those people are not at market rate.
We're going to do a foreclosure video. We've got some foreclosure numbers coming in.
Okay.
The people that are praying for someone put a comment on the blog that pretty soon there'll be one foreclosure on every street.
I don't know about that.
Okay. Unfortunately, it's not going to happen. Okay, here's another quote from the article. Inflation is real, but when you have an asset where the debt is fixed, and especially if it's fixed at 3%, and we're running inflation above 3%, you win. It's like printing money, Zuber said. It's the 30-year fixed rate debt, and that's the magic in this. Oana, do you think we're in a weird thing where as interest rates drop, more houses will actually come on the market?
Yes.
So interest rates dropping could actually put us in this weird scenario of more homes on the market.
Absolutely, yes. Because that will give those people wanting to switch homes for whatever reason a little bit of breathing room.
Yeah.
And they'll be able to accept an interest rate that is maybe 1.5, maybe even 2 points higher than what they're paying now, but not more than that.
And I think what's going to be interesting is, and we'll watch this as it happens, is interest rates drop and more homes come on the market, more buyers are going to come out. There's pent-up demand because there's all these people that want to buy. So we're going to have two things happening. We're going to have more houses, people saying, I want to sell. But then we're going to have the mover buyers, the people selling their house now in one market, moving to another. And then we're going to have the buyers that are renters that are trying to go buy too, because they're going, okay, interest rates are down, now I'm going to jump in.
Right. So, part of the reason that there are some homes that aren't moving, so to speak, that aren't selling is not just price, which, some sellers still have optimistic pricing, but it's also the product. What we tell people is it takes price to get people in the door, but it takes the product, the house, to get people to make an offer on it. So it is that combination. So to some extent, the houses that are lingering on the market are either priced not at market value, or they are a product that has been rejected by the buyers for whatever reason.
Today, I ran out to meet a couple clients that are working with one of our agents. Mm-hmm. They're buying. Absolutely unfazed by interest rates. Interest rates are they don't care. They're not a factor, right? Mm-hmm. Strictly, they only care about the product. It's like, it's your typical thing when you go to buy a house. They're just looking at the features of the house, what they liked about the house, what they didn't house. Houses were in a variety of price. They weren't all the same price. They were a substantial difference in prices. So obviously, if you're looking at a $700,000 house, then you go look at a $900,000 house. That's a substantial difference in payment at these interest rates. But they're just like, we're here to buy the house, not really worry about the cost right now, because they believe at some point rates will go down, they'll be able to refi, right? Here's a quote from the article. Redfin's chief economist Daryl Fairweather told Fortune that high rates are constricting activity. They're looking at their monthly payment, which is quite low if they locked in a 3% mortgage rate compared to what their monthly payment would have been if they bought and sold again, which would be quite high given how high mortgage rates are, Fairweather said. And it just makes a lot of sense for them to hold on to that low interest rate.
Right. And, people are also going to, at some point, the dam will break, so to speak, right? And people will just say, you know what, forget the interest rates. I don't care anymore. We've outgrown this house and we've tried to make it work, but we're done with it. We need more space. So people will go out and purchase something else at the higher interest rates, but they're going to look at the house that they have now with a low interest rate, and they're going to say, you know what, it makes more sense for us to keep this house as a rental and take the difference between the mortgage payment and the rent that this house is going to generate, and use that to mitigate the higher interest rate on the new house.
So we were, yesterday, I met with one of our investors, and we were talking about, the next house that he's going to purchase, when he's ready to purchase the next house. And he has the house he lives in, a second home, and then 3 rental properties, 3 investment properties, basically. And we were talking about interest rates. And I didn't ask him, but he just happened to say, he goes, the highest interest rate I have on any of the 5 houses is 3.25%. 3.25% is the highest rate on any of the 5 houses.
And remember, he purchased 3 of these as rental properties. So as an investor, he purchased one of them as a second home, which again, that's a higher interest rate than a primary residence.
Right.
And even with all that put together, he's still paying 3.25% or less on each property.
And I think there was a refi in there.
Yes.
There were at least one or two in
Mhm.
when, end of 2020 when
Mhm.
rates kind of
Yep.
got to their lowest amount.
Yep.
So, and there's people like that just decided to grow their rental portfolio in the last couple years. We decided to do that, right? And you just had being locked in on a low rate is, between people who can't move because they can't sell and then go buy because interest rates are too high, and people who aren't going to give up the cheap money. This is going to cause a problem for a long time. It took a while for this to build up. That's part of the reason why home prices ran up. People were saying, oh, I've still got my 5.5%, 6% loan. I never got rid of it. And I can still get a 3, 4, 5% loan. So I'll just move. And they were moving normal. And then then you had the balance changed of people with high to low loans. And then it swapped. So everyone's got a low loan. And now to get a new loan, it's a high loan. And no one wants to make that swap. It's not a problem. Historically, interest rates went from 18% and then over 20 years went down to 6%. So people had no problem selling, getting rid of their 12% loan to 10%. And then 5 years later, they would sell their house that they had at 10%. They would go buy a house at 8%. And then they would sell their 8% at 6%. And then they would sell their 6% at 4%, right? But now that everyone's got, basically used free money to buy their house, they're not selling.
Nope. It doesn't make sense. And people act in their own self-best interest.
Yep.
So what do you think? Does this make sense to you? What's going on in your market? What are you doing? Are you selling? Are you staying put? What kind of interest rate do you have? Leave us a comment and tell us what's going on. We like hearing from you. Please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.